Today we're going to talk about debits and credits. Okay, we're moving from Chapter 1 to Chapter 2. And in Chapter 2, there's a tool that we use for analyzing transactions. It's called a T account. And here's a picture of a T account. It looks like the letter T. The name of the account goes above the T. The left-hand side is called the debit side. And that word debit, you could take that to mean left. That's all it means, is left. And the other side is called the credit side. A good definition for credit is put it on the right. So basically debit and credit mean left and right. All right. Now from Chapter 1, we already know something about certain transactions. So let's take a look at this first one here, Transaction 1. Johnson invested $20,000 in the business. Cash goes up, owner's equity goes up. Now, if that sounds strange to you, you need to go back to Chapter 1. Sometimes people have trouble with debits and credits, but it's really because they're studying Chapter 2, but they didn't master Chapter 1. So why do we have a Chapter 1? To get you ready for Chapter 2. So on this first transaction, we are going to enter that $20,000 that Johnson invested in the accounts. And I've put the accounts down at the bottom of the page. So I've got T accounts down here for the assets on the left, cash, accounts receivable, and supplies. In the middle, I've got accounts payable. And the owner's equity, I've got a drawing and a capital account, rent expense, and service revenue. And I'm going to do something here. We're not going to use the right-hand side of the drawing, nor are we going to use the left-hand side of the capital. You can just forget about those for the moment. And with rent expense, not going to use the right-hand side of that. And with service revenue, we're not going to use the left-hand side of that one. So that's going to make things a little easier. Now on the rules here for debits and credits, I put those at the very bottom. And an increase in any asset is recorded with a debit. That means we put it on the left. So going back to Transaction 1, the owner invested $20,000 in the business, and that was in cash. Put your $20,000 here on the left-hand side of cash. You could put a little 1 by that to show that that is the transaction being referred to. The other thing that's happening is the capital account is going up. And so we put the $20,000 also on the right-hand side of the capital account, a little 1 by that. When you're reading the notes later, you can refer back to the original transaction. All right, and in Transaction 2, they paid rent in cash. I forgot to put the amount. Let's say it's $1,000. Cash is going to go down, so that $1,000 is spent from the cash account. Find your cash account in the T accounts. $1,000 on the right. This will be Transaction 2. And that represents a decrease in an asset. That's why we're making the credit. Over in owner's equity, we also have a decrease in owner's equity. A decrease in owner's equity, take a look at the rules at the bottom of the page, is recorded with a debit. So a $1,000 debit to rent expense, and that's also Transaction 2. Transaction 3, we're going to buy some supplies. We're going to buy them on account. We're going to buy $500 of supplies. I'll just write that in, $500 of supplies on account. So the supplies are going to go up. That's an increase in an asset. Increases an asset with a debit. So $500 to supplies here, Transaction 3. And notice your liabilities are going up. Accounts payable goes up in the same amount, $500, Transaction 3. All right. Transaction 4, we're going to earn some revenue, and so that means our owner's equity goes up. in the owner's equity, I've got a service revenue account. Let's say the revenue was $3,000. So let's write in 3,000 here. So your revenue is an increase in owner's equity, so $3,000 on the right-hand side of the revenue account, and that is transaction 4. And accounts receivable is also going up. Accounts receivable is an asset, so $3,000 debit to accounts receivable, transaction 4. Transaction 5, we're going to pay some cash on account. So we owe somebody some money, and we're going to say we're going to pay them $200 of the $500 that we owe them. It's going to be a debit to accounts payable. Notice that liabilities go down with a debit. You're going to have to get used to that. That's going to be transaction 5, and we paid that in cash. So a credit of $200 to cash on transaction 5. Finally, one of our customers who owed us money paid us that money, so our cash goes up and they don't owe us the money anymore. Both of these are assets. So cash is going up, and the amount that they paid us was $1,400. So a debit to cash, it's going up, $1,400, transaction 6. Credit to accounts receivable. Notice that accounts receivable, another asset, is going down by $1,400 on transaction 6. All right. What you could do at this point is determine the balance of each account. And so to do that, look at your cash account for a minute. You would take the $20,000 on the debit side and add $1,400. But then you've got credits of $1,200. You've got to subtract that. Your cash is going to end at $20,200. Your accounts receivable, we originally had $3,000 of receivables, but we received $1,400, so we're going to end up with a $1,600 balance in accounts receivable. Supplies ends at $500. Your accounts payable will end up at $300, a credit balance. There were no drawings. Capital ends at $20,000. You have your revenues and expenses. What I like to do is draw a box around those, because this will be your net income. You can see the net income in there is going to be $2,000 at the end of the story. All right, well, this is an introduction to debits and credits. Go slowly with these. They will become second nature before very long. And I wanted to start you off with kind of a smallish problem using debits and credits. Take your time, learn it well. Part of the reason we learn debits and credits is that later I can tell you how to handle a transaction and you will understand it because you're using the rules properly. So once again, the assets go up with a debit, they go down with a credit. For both liabilities or owner's equity, a credit is an increase. I think that's the hard part. And conversely, a decrease in liability or owner's equity is with a debit. Okay, this is an important tool for Chapter 2 and everything that comes afterwards. So spend some time with it. All right, thanks for watching.